Hi, everyone, and welcome to another episode of Mint's Pivot or Perish webinar series, where we look at how companies and investors are adapting to the post COVID world. I am Mihir Dalal, and today we are focusing on India's startup ecosystem. The pandemic has affected all businesses, but its impact has been very uneven. Some companies, like those in edtech and health tech, are benefiting enormously, but sectors like travel and mobility have been badly damaged. Many companies have adopted emergency measures to survive and extend their cash runway. Over the next hour, we will discuss these and some other key themes that are occupying investors and entrepreneurs. Joining us this evening is a panel of experts from the startup and venture capital space. We have with us Yashish Dahiya, CEO and co-founder of PolicyBazaar.com; Upasna Taku, co-founder and chief operating officer, MobiQuick; Vivek Sundar, chief operating officer of Swiggy; GV Ravishankar, managing director at Sequoia Capital India; Navneet Chahal, partner at Bain; Shanti Padmanabhan, VP at Salesforce India. And also joining me is my colleague and co-host, Tanya Thomas from Mint. Welcome all. Let's start with GV first. Um, GV, because of the pandemic, deal activity in April and May had come to a near halt, and a lot of people were predicting a doomsday scenario. But from June onward, investment activity seems to have picked up a lot. Could you just give us a sense, of the venture activity and whether you've seen a drop in valuations and deal sizes, and also perhaps just, give us a sense of whether normalcy has really returned in the venture space?
Thank you, Mihir, and it's a pleasure to be here. Thank you for having me. Um, Look, obviously, we are going through some unprecedented times, at least for many of us who are in the investing world and the startup world. We've obviously seen also significant impact in deal activity, at least in the first 2 months, like you rightly pointed out. Going into April and May, investors were trying to understand in the current environment how they meet startups, how they work with them, how they evaluate them, and so on. Meanwhile, companies themselves, startups themselves, were trying to figure out the impact to their business from the pandemic. And for many people, and most of us would have thought maybe late March, early April, that this is something that will be there for a couple of months. Maybe we all get back in July, August. There'll be a sense of recovery, etc. And nobody expected things to be much more prolonged and elongated. And it became clearer as we moved through. So then step two is kind of saying, hey, look, how do we first assess what's going on? How do we survive through this period? And then how do we build towards the future, right? So most companies have, in the first couple of months, focused on reducing their costs, making sure they have a runway for them to kind of think about future. And then in June, July, people have started, slowly coming back to some level of how do we operate in this new normal world. And in a way, that is also reflecting in how maybe VCs and others are also investing. So while April and May were broadly slow months, there was still some activity and there was some investments. Most of them may have been carried over from companies that you're meeting and kind of having discussions with, and you took them through. But as you look at June and July, and as you know that this is going to be a much more prolonged kind of a recovery period, people are coming back to normal. Most of us have started to, invest over Zoom in a way, like learning how to do this, how to assess founders, how to spend time with them and learn about them much more on virtual mediums. So we've kind of evolved and adapted, which is, I'd say, the number one thing about the startup world, which is never say, you never kind of give up, and you're evolving constantly and innovating for you to survive and, thrive as things start getting on.
Right. So, have valuations and deal sizes remained pretty much unchanged, even if there's been a fall in deal volume?
Yeah, it is. It is interesting and surprising. One would have thought in this world, valuations dramatically correct. I would say, valuations have not corrected that much. You obviously saw public markets have a significant correction, and then things have somewhat come back. We think of private market valuations to be sticky on the way down, meaning they don't come down that quickly, and it takes a period of elongated period of time when the activity is subdued for valuations to come down. But again, a lot depends on which sector you're in, right? In fact, if you're in tech, health tech, like you pointed out, valuations have not corrected. Maybe they've corrected upwards in a way that there is much more demand for some of these businesses. And if you
Yeah.
are in segments like in travel, etc., either capital is not available, or if it's available, you will have to somewhat forget what your last round valuation was, and then relook at valuations today.
Sure, sure. Yashish, could you tell us about how business has been for you? Are sales really back to pre-COVID levels for the group overall? And if not, how long do you think it could take?
See, I think a startup by definition is something which, if it is not agile and if it is not very quick to adapt to changes, it cannot survive. And we certainly classify ourselves as a startup. Uh, we had 17 business units, of which two or three contribute a very large part of the revenue, and those two or three have thankfully done well. But that is, we can take part of the credit from an operations perspective, from a clairvoyance perspective, from a preparation perspective. But a lot of it was because COVID happened. People are a little more worried about health and life insurance, so they are searching a little more. And organizations, because physical contact was less feasible, organizations came together and put the rails, as you would say, much faster than they would otherwise. But then, I would say there are probably 5, 6 business units which got totally wiped out. When I say totally wiped out, I mean more than 90% of the revenue gone. We were lucky that we had 17 business units, right? So we could move people, we could move resources from one to the other, we could focus on the right things. So thankfully, we were in a position where we were fairly well capitalized. Our primary operations kept going. Overall, we continued to hit plans as a company, and we could handle the little market variations without being very short-termish in our approach. We didn't have to get rid of any of our key resources. We didn't have to close down any of our key departments, all that. So even for the business units where there has been a massive decline of revenue, we were able to continue to focus on the long term and continue to focus on more digitization. And I think we were lucky in that respect. I think if each of these business units had been on their own, they might have struggled.
Right. Vivek, what about Swiggy? I mean, obviously, food delivery volumes have taken a hit over the last 3-4 months. How long do you think volumes will take to get back to pre-COVID levels? And till the time they do, is Swiggy really focusing, on entering new categories and new business line to recover revenue levels, or is it that the main focus remains on food delivery?
So thank you again for having me here. It's a pleasure to be here. As kind of, this business has actually gone through a perfect roller coaster with all the G-forces that you can imagine in a roller coaster. We had an absolute shutdown where, practically almost all of our 500 cities were shut in the first phase. Then 200 opened, and then we were sort of slowly getting along. And then you have all these wild gyrations because there is some pizzeria in Delhi that you wouldn't believe. There was a pizzeria in Delhi that actually had one of its staff test positive. The whole of the country's business starts tanking. The next time it happens, it doesn't tank so much. So it literally has been in a roller coaster where you're not even sure if the seatbelt is on. So we've had to obviously play the game almost one day at a time when we were not sure which cities will be operational, which cities will have lockdowns and everything the next day. So moving from a daily stand-up to know which cities are operating and therefore which cities should be switched on versus off, to a situation right now where we are saying the long haul, which is basically getting customer trust in the category and customer frequencies back, is where we are right now. In the middle, we obviously had capabilities that we believed were even more relevant for the problems of lockdown, which is essentially understanding consumers, understanding technology, and having hyperlocal operations. So we basically entered into pretty much deliver anything that was allowed and that was needed for the consumers. So we got into delivery of groceries in 350 cities in the space of a week. Now, this was with every one of our employees locked in. It was crazy to think about starting 350 cities by every employee just being sitting at home. We had to onboard Kirana guys on the app virtually. So we did all of that. Then we, of course, started delivering other things when opening up happened. So today, as we speak, yes, we do have a recovering food delivery business, which has gone through its gyrations. And then we have new fledgling businesses that are also going through their gyrations, because obviously grocery was growing really hard when the core of the lockdown was on. When opening up has happened and grocery shopping has become something that consumers do, then that business has come down. So it's a bit of a multiple roller coasters, put it on an Excel sheet, and that's essentially our business. But we've had to be daily agile or weekly agile to be able to cope.
Yeah. So is it fair to say that it could take another 3-4 quarters for food delivery volumes to recover properly?
I'd say, yeah, maybe 3-4 quarters is a good time to safely get into that recovery zone. But I do think that there will be pockets that will recover faster than others. And that's the important thing for us to understand what those pockets are. And those pockets could be geographic pockets or consumer cohort pockets. So we are making sure that we're slicing and dicing the business in a way that we understand which pockets have recovered, which pockets actually have new needs, and therefore how do we cater to those needs. The reality is that we had a very large number of our midday office orders. If you've gone to office buildings during the pre-COVID era, you will see lots of Swiggy boys and girls milling around the offices. That's gone. But now you have a different problem, which is people at home going through millions of Zoom calls and trying to sort out food at the same time. So new use cases have emerged in terms of what we need to solve for, and we are constantly trying to solve for them.
Right. Upasana, in payments, the impact has been more or less neutral, really, because some categories seem to have obviously declined, like travel and movie bookings, etc. But usage has increased a lot across categories, like bill payments in particular. So what has it been like for you? Are you at pre-COVID levels already? And how does the next how do the next 2-3 quarters look like?
Firstly, thanks for having me here, Mihir. Really enjoying the amazing company and hope to learn. On the payments front, you're right. Like travel, food, some of the other categories will have a slow, growth coming back. Especially travel, as you know, is a very large segment, both on consumer payments as well as our payment gateway business. So that has been a hit. But thankfully for us, because our business is fairly diversified, even within payments in 5-6 large areas. So through the main COVID months of April, May, we saw about 30-35% drop in overall revenues, and currently we are in the 20% zone. So we expect our revenue to recover, quite well to our pre-COVID levels by end of September, early October. Aggressive if we get the whole thing back in September, but worst case in October we'll be back. And this is our overall revenue. Now, that said, you already spoke about some sectors are overperforming because when people are completely locked in, they tend to do more things digitally. Interestingly, we've also found that even in-store payments have increased using our platform. And that's because people actually don't want to either pay in cash notes, and neither do they want to give their card to swipe in a POS machine, because you would still have to, touch the machine and enter the PIN, etc. But of course, we also have a credit business which we have developed over the last 2 years, and there, as numbers have gone down significantly. No one wants to do aggressive lending right now, so we have also been conservative. And of course, a lot of work has happened in terms of collections and moratorium and all of that, so dealing with that. So we continue to use this time very fruitfully in terms of new product development and new business launches. In fact, we launched 2-3 major products in the last couple of months. Just launched one today as well, unique payment link using UPI for users. And in August and September also, we expect to do new launches. So while there are certain segments which we think will take time to recover, we have used this time well to get new products out, which will start generating faster, newer revenue streams for the company. And it is definitely our view that everyone should invest the time well in terms of survival and growing. I think one point I will make is that I appreciate it has been a very difficult time for several companies, especially travel, hospitality, etc. I think one of the benefits we had coming into COVID is that we were actually prepared for COVID, because in the previous financial year, which ended in March, we actually forced ourselves to become profitable. And so all the things, difficult things that people have had to do in the last 3-4 months, reducing fixed cost and deploying capital in areas which will have a faster payback. I think we did all of that in the last year. And so in a way, we were, let's say, more well prepared than others. But I think it's a good time that most companies are thinking, differently about their cost base and growth plans.
Right.
Thanks, Upasna. It's interesting how the use cases of companies innovating and with limited resources available, stuck at home, we're all trying to work differently and still keep things going. And on that note, I'm interested in knowing what are the operational efficiencies that you've been able to bring into your businesses over the last couple of months that you wouldn't have thought of earlier. And Vivek, if you could take that, and Navneet, I also wanted to ask you if you could follow that up with telling us how you're seeing startups evolve and how they've forced into this evolution.
Navneet, do you want to go first?
Navneet, yeah, sure. We'll get to Vivek later.
Sure. So I think it's been interesting over the last few months in the sense that there are few choices that have gotten forced, and I think in light of those choices, I think folks who've been more opportunistic about it at least are trying to now take a fundamentally different look at what these operational efficiencies could be. So almost not think about your cost structure incrementally and try to sort of solve for the next 4 months as the time you need to tide over, but rather almost take this opportunity to almost zero base your cost structure and try and think about what are the changes that are going to stick around, whether that is from the perspective of the business model that you might want to evolve, or even from the cost structure that you have today to serve the demand that you have. So I think in some sense there are several elements on the P&L that require a very hard relook, starting right from this digital way of working and the fact that it's become a way of life now for most organizations. So thinking right from there to how both you need to solve for obviously a better cost outcome given the demand challenges that you might have at this point in time, but at the same time keeping an eye out for using this time, like Upasna said, to innovate on both ways of working as well as the kind of operational efficiencies that you can extract over this period of time.
Vivek, anything for us? And what are the kind of changes you made?
There are obviously operational efficiencies that have been given to us as a gift, looking at the sort of positive side of life, which is more people being locked in means more people per order, which is good for a food delivery business, because obviously the unit economics is very dependent on how many dishes are in an order, therefore how big is the order. That's, let's call it luck, that people are locked in and they're hopefully, they're thankfully ordering together. But on things that we control, there are choices that we have made which actually take the operational inefficiency that was natural in a food delivery business with the peaks that we used to have, and basically we've been able to plug the peaks, because most people aren't ordering grocery and their food at the same time. It actually nicely mirrors the peak of one, mirrors the trough of the other, and that's great for operational efficiency. Also, these tasks that people are using them for, Swiggy Genie, is also typically done during those off-peak hours, which is also great for efficiency. Some of it is, of course, because we are encouraging those troughs to be filled. There are operational efficiencies that we have gained by even looking at ourselves in terms of how we are operating in this mode which has constraints. And then we have said, hang on, but even after the constraints go away, can we not make this the new normal, which are as much about how many people we are deploying to do a certain piece of work to how we are leveraging technology to do a piece of work. It's vast. I'll give you a very simple example. To get over 10, 15, 20,000 of Kirana guys who've never interacted with Swiggy to download an app which is an owner app, and then to use that app in a way that they can actually accept the order and fulfill the grocery order, in the old world would have needed salespeople to go and onboard them. and to bring them onto the platform. And then, of course, there's a commercial deal to be done. And then hopefully they start using it. And then that's the connection between the consumer, the grocery store, and Swiggy. But because we were locked in, we had to do it on the fly, and we had to do it sitting. So we created digital training modules and stuff like that. And today we are sitting there and saying, if we could get the long tail of grocery to be able to be onboarded without having people to go and deal with it, as we start expanding into other areas, we are just using that efficient way to do things. So I think there's a whole host of efficiencies that we have learned along the way of what can be done because it's a gift, and what needs to be done because that's a constraint. And I do think that when the dust settles, we will definitely, I mean, even today, we're a much more efficient company because of the fact that we've been looking at these efficiencies and plugging them in to the base operating model of the company.
GV, even before the pandemic had struck, there was a lot of talk about how there's going to be a reckoning for internet startups globally and in India as well, especially those companies that haven't shown a clear path to profitability. How has it, 4 or 5 months into the pandemic, how has this reckoning really panned out? And how do you think this downturn is going to be different from previous ones?
Yeah, it's a great question. So, if we step back and look at, and maybe answering the second one first, right? How is this time, different from earlier times? In the past, when we've seen cycles, maybe the global financial crisis and the offshoot of that, what you saw was not a consumer demand problem. You saw a kind of a funding problem where there was uncertainty on ability to keep growing because capital may or may not be available. And we saw seen that like in 2009, 10, maybe a little bit of that in 2015, 16 as well. But what we are seeing now is a completely different problem, which is you don't know how to estimate demand. Will consumers be confident enough to come back? Will you be able to supply to the demand because of lockdowns, etc.? So it's a completely different type of crisis we are going through right now, where maybe for the first time companies are starting to worry about saying, hey, will demand be a true issue, and when, if at all, will it come back, and what are we facing, right? So that's the context. Now this is completely well understood, in my opinion, by most startups today, and like I said, maybe when we started in April, most people may have thought it's a blip, it's going to come back, because we had this tremendous growth wave for several years coming into this. But now it's very, very clear that the people that will survive and thrive are the people that have.
GV, I think.
Sorry.
Could you repeat the last sentence?
Yeah, I was saying to the credit of companies, I would say people have actually taken very swift action, right? So not only have they corrected cost structures, but also people have kind of taken the view saying, hey, a lot of the growth that I may have gotten before may have been somewhat bought growth, meaning you discounted, you did things that were somewhat artificial to keep growing, because there's this view saying, hey, capital is going to be available, I need to be the winner out there that outlasts everybody, outruns everybody. Now the view is, look, markets are uncertain, demand, we don't know whether they'll come back. So, and capital is also relatively uncertain. So most founders, at least I know and I speak to, are saying, look, we want to do the right thing for the long term, right? This is not a 1 year, 2 year race. We have to win in the very long term. So what's the right set of things that we need to do? And so they've taken tough calls. It's not easy. I can tell you it is a really difficult process. And many people have gone through this, where they have to call a bunch of employees and tell them, please take 50% compensation hit, or, I may not be able to pay you, for the next 3 months, etc. But they've done those tough things and also corrected their business for them to be more sustainable, which you see across, right? I mean, most people on this call running a business have actually corrected their cost structures and gotten leaner, meaner, better, which I think would be a great way to come out of this crisis, because you're going to have much more sustainable companies come through on the other side. So I'm actually very optimistic about how companies will go through this. The message is loud and clear. They're doing the right things, and I do believe they'll come out healthier.
Sure. So you had mentioned earlier that usually, valuation drops and generally like things like valuations going down take a while to come through. Do you expect like a large scale, startups to suffer large scale drops in valuations, with the exception of a few sectors like ed and health, or do you think like most companies will be able to survive this with their valuations intact?
it's a very, very tough one to answer. From a theoretical perspective, yes, given, growth rates of affected companies or, maybe even smaller, valuations should correct. But we are also seeing an overlay of where global liquidity is, right? So, globally, there is actually a lot of capital that is flowing in, where any growth is going to be seen positively. So, and if you are particularly in tech enabled sectors, you're kind of seeing an acceleration of adoption. So at least from our perspective, we are not sure there's going to be something dramatic that will change. Now, if for example, global markets dramatically correct, and that is being felt here because we're also interconnected in that sense, then maybe there will be correction. And if that continues for a 12-18 month period, then you will see it. But we are not seeing it. And if US continues to be the way it is, where markets and particularly technology stocks have done so well, we actually don't know if there will be any significant correction. And from our perspective, again, Mihir, look, we are investors for the very long term, and so we also know that you can never do an unfair deal with a founder, right? So you got to find the right balance. There will be great bull cycles where great valuations happen, and there'll be some other situations where valuation is less good. But it'll always have to be somewhat fair, because if that is not the case, then you won't have a great relationship. So from our perspective, we are seeing this as in the next 12-18 months, if things are not great, then can we find great companies and invest in fair prices? We are not looking to find great opportunities and try to buy them at steep discounts, because we don't think that's a sustainable way to enter a relationship.
Sure. But what you're saying is that whether there'll be like valuations of companies will largely be affected by, apart from the company-specific factors, they'll be affected by macro factors like US interest rates, public markets, and stuff like that.
Absolutely.
Okay, got it. Yashish, how are you approaching, fundraising? You've mentioned that you're looking at an IPO. So could you just take us through, like what exactly are you looking at in terms of this last pre-IPO round of financing, and generally what has been your like from your interactions with investors, what is the sentiment right now in terms of funding such a late stage company like yours?
I think we're still growing fast enough.
Yeah, sorry. I just we lost you for
I like the fact that you say we are late stage. We always thought we were fairly early stage. Depends on what you're looking at. But I think, as GV mentioned, I'm changing my thought process a little bit. I always believed that when the water kind of goes down, the ones that are swimming naked will be found naked. But I think the water is not going to go down. That's the conclusion I'm coming to. That there is enough water out there that the water is not going down. Now, I'm not saying we were ever swimming naked. We always had our swimming trunks on. So we were actually hoping the water will go down, but the water is not going down. And that's a strange thing, right? But most companies that are operating well, focus on the future, but also deliver in the short term, actually want a correction, because we think the glut of capital is so huge that even companies that do not see, I think all of us need to be very long term in nature. We need to always focus about the next 10 years, the next 20 years, but we also have to deliver something in the next 2 years. But then you have companies that do not deliver at all for 5 years, 7 years, and still are able to raise a huge amount of capital. And that, kind of bothers people like me. But I don't think that's going to stop. That's my reckoning. Some great investors may not do it, but there'll be enough other ones who will still continue to do it. Because of the amount of capital available. That's just crazy, right? Out here, you've got in the UK, you're seeing minus 0.1% negative interest rates, which is like crazy, right? So money is just available for free. Now, coming to the second part, how are we looking at things? I think, at some point we have to do an IPO. We're becoming fairly predictable in terms of how we go about things. But we are not doing any pre-IPO, etc. right now. We're far away from that. Even if we are talking about an IPO, we're talking about at least a year away. And a pre-IPO would probably be 3 to 6 months before that. Don't want to speak too much about Policy Bazaar per se, but we are fairly well capitalized. As I've said repeatedly, we've raised $330 million. we still have $210 million in the bank. Now, I just wanted to mention one thing. I think it's unfortunate, and it's unfortunate both from a media perspective and from a consumer's perspective and from a country perspective, that companies that are capital efficient, which is what Sanjeev Bichchandani always tells me. See, InfoEdge never raised more than 7.5 crore rupees. They raised 7.5 crore rupees and built a multi-billion-dollar business.
Yeah.
Right? But today, the passion is for how much capital you can raise. And sometimes as a founder, I feel inadequate that I haven't raised a $500 million or $1 billion round. So there is always that urge to raise a big round, despite the fact that you may not need the capital. Because that's the only way you'll be counted like a great story or whatever. So I think we've got it all a bit lopsided. That's all I'd say. We celebrate fundraisers. I recently had, I must share this one incident with you. There's this company that's kind of valued at about $150 million, and they raised, about $30-40 million. And the team is saying, we raised $30-40 million. So what share of this should we take away? As in take out of the company. Because they believe the objective was to raise money. The business is massively loss-making, probably will never, ever come out of this. The investors will most likely lose all their money. But the management thinks they've achieved a lot because they've raised $30-40 million. Yeah. So just sharing, that's another perspective to the story.
Yeah.
Shanti, I'd like to bring you in here on the subject of valuations itself. We've seen a lot of investments, a lot of interest now into online gaming, entertainment, edtech. A lot of interest coming in there, and we know that there is a lot of dry powder with Ps and VCs. So what are you seeing as the growth areas for investment? Is SaaS, for instance, if that story is still on?
Yeah. Thank you, Tanya and Meher. I hope I'm audible. First of all, huge appreciation for my industry colleagues on the panel who are confronting the crisis heads on. It's very inspiring. See, as you know, I work in an organization that founded customer success as a function. And as a team, we've always been focused on how we can drive success for our customers. How do we help them to get the business value from the technology investments? And in the last few months, we found ourselves to be right in the middle of the storm. As we have seen firsthand, the challenges of our customers, and in many cases, we walked alongside them to successfully manage the situation on hand. And that is the lens I'm wearing at the moment. Clearly, my colleagues on the panel have had experiences which are quite enriching. What I see from my side is that this crisis has definitely accelerated our ability to embrace change. And if you were to call out only one thing that is making the difference for companies, it is leading through change with increased customer connect and enhanced customer experience. So we have a significant SMB business, of which 40 to 50% are startups. And close to 42% of our customers say that their biggest challenge has been to keep up with the changing customer expectations. 64% of our SMB customers have invested in a customer relationship management system, and that is certainly helping them to connect with their customers better. In the last quarter alone, and it's very, very surprising stats, but in the last quarter alone, we have grown actually 30% in terms of customers who have come to us who are investing in the technology of customer relationship management. Year on year, we've grown 30%. So that just shows that our customers are increasingly focused on exponentially growing their customer connect and driving positive customer experiences for their customers. And one of the best examples that I can think about is a startup. I think most of you will be familiar with it, startupwala.com. It's a professional services firm that provides legal service to other startups in India. They have been a Salesforce customer for at least 10 years, early movers, obviously, who invested in our technology very early. But very recently, they built a self-service app that customers can follow their requests and track status. And it's very energizing to see that they've seen a 55% uplift in sales and a 40% boost in customer satisfaction and 70% decrease in deal closure time, pointing to improved productivity and efficiency. So clearly my message is that technology is right in the middle of the storm, And startups and organizations that embrace technology will clearly come through successfully, although the difficulties along the way will be quite challenging.
But it's hard, retaining customer loyalty at a time when consumers are cutting down superfluous expenses, when everybody wants to trim the fat, and we're living in times when everybody is either dealing with job losses or pay cuts, and the economic situation is very grim. So how does a startup retain loyal customers, or even let alone increase its customer base in times like this?
So that's a very good question, Tanya. Two big shifts that we are observing when we talk to our customer base. See, while in the past we would have a bi-weekly connect or a monthly connect with customers, of late the frequency of the connect has significantly gone up. Sometimes even once a day to check in. So it is almost as if we are walking the shoes of our customers. And this is true of our customers as well. Every customer, while challenged with optimizing their internal ops, as you have called it out, are equally focused on winning, retaining the loyalty of their customers, and driving actively changes that will help them to continue to keep their customers. So customer centricity as a topic has never ever been more significant than in the last few months. The other shift that I see is many of them are thinking past the immediate crisis, and that is where they are able to think beyond the immediate crisis to see what kind of investments are truly required today in order to be able to leverage technology as a medium for growth and a fuel for growth. And that's a huge shift. Just as an example, earlier, whenever investments were made in technology, close to 25% of the SMB business would not adopt the technology early enough. It would not be leveraged, and it had to be a long cycle time before they could get the best out of it. And in the last 3 months, we've seen so many businesses go live on the technology axis in order to drive adoption. And clearly, from an adoption perspective, just to give you another stats again, where there are organizations, again, startups, SMB space, organizations where the adoption was in the range of 50 to 60, you clearly see now that they are upwards of 80, 85%. So all I'm trying to say is that investment in technology is the way to go. It's not, of course, a silver bullet, because there are several other factors that needs to be put in place too. And the current crisis is a challenge for many of us to cross. But if there is one thing that we need to get right, and that is the right investment in the right technology.
Tanya, if I may, I think in the
Yes, please come
in the B2C sector as well, I just wanted to call out that it's actually a good time to be building intimate relationships with the customer, because like you said, there will be some depression or compression in spending. But what that actually translates to is that I, as a consumer, will become that much more specific about the right platform or the right company that I want to spend this money with. And I think what that entails and what that means for brands and companies is that they need to double down on, like you said, the loyal customer base, and how do they then generate more intimate experiences for these consumers. And to what, for instance, Vivek pointed out earlier, this is about identifying new use cases. The constraints don't only exist for companies, they exist for consumers as well. And I think what that will probably entail is just a shift in the way companies serve customers, probably a shift in operating and business models that can actually translate to this becoming a time when you can actually generate greater customer loyalty. We are starting to see that with some of our clients, where just the direct tangible P&L impact is also starting to become evident as customers engage more repeatedly with companies that they prefer and like. So it's actually probably a good time to invest into building customer loyalty.
Thanks. Vivek, I had this question about, you earlier mentioned about how you guys have expanded into hundreds of cities in a matter of days and weeks because of the pandemic. Now, some of these categories, especially groceries, I mean, these are notoriously difficult categories to crack, and margins are very, very thin. So is this more of a stopgap measure by Swiggy, to use its fleet that would have otherwise gone unutilized, or is Swiggy trying to become like this very wide-ranging hyper-local app that will do everything for you?
No, so we had a 3-year plan saying 2020 COVID will come and we'll expand to 300 cities. And so we did, because we had a secret bullet. I'm joking, obviously. The reality is, I think you're right. It is the fact that we were in a situation where food delivery was shut and the delivery partners were essentially idle. And troubled by that fact, because they are gig economy workers. So obviously we felt at that point of time it was the right thing to do. Consumers are asking for it, government stakeholders are asking for it, and so why not? So we did that. It's not, and we learned a lot along the way. We knew that some of it will go away when unlock happened, and some of it is going away. But the learnings that we've got from there are both useful for us operationally as well as commercially, in terms of what they're willing to pay for and what's the commercial ecosystem that's in place. So I can't pretend that we have a sort of roadmap on how to deal with this notoriously difficult category called grocery. But I can surely say that COVID and lockdowns and the unlocks have given us a boatload of learnings that would have otherwise taken us maybe 2 years to learn. So that's probably a more accurate statement of where we are. I don't think we know where we will be in 6 months from now on grocery. We think we have some ideas and some bets are there, but I don't think it's fair to say that we can actually place a
so it's
sort of
fair to say
roadmap
that
for the next
Swiggy will
1 year.
primarily, for the next few years, continue to be a food delivery company rather than like a overall hyper local app.
Well, at this moment, I think it's fair to say nothing about the future. But I think what is fair to say is that in the grocery experience, we have learned that certain categories within grocery are much stickier and much more likely to persist on online, on Swiggy, much after unlock completely happens. And you will see that if you open the Swiggy app, there is groceries, of course, but then there's also specialty categories that we think make sense for consumers to order. And you'll see that with meat stores and pet food and stuff like that. So there are some verticals that have come out of the sort of mothership grocery that we think will have a place to exist for the future. And so I think it's fair to say that at this moment, food delivery is obviously still our mainstream, but how 12 months later are the shape of our business be is not known. But frankly, I don't think it's stressing us out, because the reality is, if you think about as long as every one of these categories is leveraging the 3 strengths that we believe we have, which is technology, consumer centricity, and operations, hyperlocal operations, we're fine. We can figure out a way to make it all work.
And how are you approaching fundraising? You've obviously cut a lot of costs to increase your runway. But would you consider raising funds over the next 18 months, even if the environment continues to be not so great? Or do you think you want to, ride out this downturn, however long it lasts, and wait for another funding boom to raise your next round?
So I can honestly say what was true even before the COVID happened, and also before the WeWork and the sort of the cold that everybody caught as a result of the SoftBank WeWork stuff. We said that we have scaled, and remember, we had scaled in the middle of 2019. We'd hit 550 cities, and we said now this scale, which is a blitz scaling approach, needs economies of scale. Scale doesn't immediately give you economies of scale. There are flabby ways of growing, and blitz scaling often can leave flab in the side. So we said, now that we've scaled, let's get to economies of scale. So our journey on getting the economies of scale and getting efficient actually predates COVID by at least 2 quarters. So we had 2 quarters of plans in place to get more efficient so that the cash burn can come down. And happy to say that journey has had its twists and turns because of COVID, but it continues unabated. So we think that the focus needs to be to get the core businesses to be self-sufficient and continue to invest in new businesses, because of course innovation is the lifeblood of any fast-growing technology company. So we think we should basically have the core business moving more towards economies of scale while we continue to fuel and try and perhaps fail in new businesses. So that's kind of the dichotomy, or the sort of two-sided approach that we want to apply to our fundraise and fund spending.
Sure. Upasana, in fintech, a lot of startups have tried to become everything for everyone, including, we've seen a lot of neobanks come up as well. What does MobiKwik really want to do over the next 2-3 years? Are you also attempting to become like a one-stop services platform in fintech?
I think MobiKwik's goal has always been to be, a consumer payments company first, and that's what we did for almost a decade. In the last 2 years, we took this position of pivoting slightly because the margins in payments are so low to sort of add fintech products as cross sell on top of the huge amount of data that we have on our users. And so I think when it comes to one stop for all your financial needs, I think that we would definitely not try to become a super app of everything. I think we've seen our peers in the payment space do that, and we don't think that's the right focus area for us. I think our focus will be to continue building credit led payments. We do believe that India has very poor numbers in terms of people who have a general consumption credit product, namely a credit card. That number is 55 million cards, and about 25 million Indians have one. And so I think our onus is to see if we can become the issuer of the largest digital credit for 100 million users over the next few years, because it creates a very interesting cycle. We only give credit in the wallet, and that money can only be used for paying on our platform. And it creates a very good network effect for us, and also engagement for the user is high. So I think in terms of our short term and long term aspirations, I think we'll stick to a few other financial products in the vicinity. We have some play in the investment space for users, and some aspirations of distributing other financial products, but not looking to become a neobank at all. And I think the key things, people will come to MobiKwik for will be payments and credit in the form that I just described to you.
Sure. GV, you guys, just announced a very large new fund for India and Southeast Asia. Coming in the middle of the pandemic, it was all the more impressive, especially the size of the fund. So I was wondering, like in some other sectors, we've seen where the bigger companies have just become more powerful and have, used this pandemic to really kind of strengthen the hold over the market. Do you think something like that could happen within venture capital itself, where some large funds like yours, Lightspeed, Axel, etc., they could become more powerful and leave lesser space for independent funds?
It's a question I've not thought about in the way that you're asking me, but let me try to articulate at least our point of view. I think, look, our business is such that there is some advantages of having a track record over a long period of time, because the best founders want to work with the funds that have the best, other founders, and the network that they can offer and help they can offer. Scale is of some advantage because we can invest in the right kind of resources to help our portfolio companies. For example, we have amongst the largest set of portfolio specialists that can help companies with marketing, finance, recruiting, support, PR, and so on and so forth. So it does have some advantage, but quite honestly, the way we think about it is, look, we are only as good as our next investment, in the sense that we have to be on the ball all the time, and not assume that we have any specific advantage that will sustain every year, just because of scale, right? So we have to meet the next entrepreneur who is kind of less discovered, who is sitting maybe more not in the top cities, is probably not coming from the places your networks are more strong in. We have to be really on our toes, and from our perspective, we don't want to take it lightly just because we have scale or a brand that we can easily succeed. So we want to be constantly finding the next set of big winners, enduring companies that are being born today, even during the crisis. And many such companies do come out during these crisis times. And we just want to be on our toes
Sure,
all the
but
time.
it's fair to say that the pandemic really hasn't made any difference to your fundraising plans or to your investment priorities and strategies over the next presently.
It has certainly sharpened our focus, Mihir. So, from our perspective, we were over a period of time investing across sectors, and we were slowly investing much, much more behind technology and technology-enabled teams. It's sharpened our focus towards those areas even further because we do think there's been an acceleration in technology adoption and the use of online across the board. And so, from that is actually a phenomenal advantage for companies that are kind of thinking about technology being their primary kind of source of power, right? So and as investors that are backing such companies, we feel like we've also started focusing much more towards those themes because those are the themes of the future and those have the opportunity to be non-linear value creation opportunities. So that would be one thing that certainly this period has sharpened our thinking around what we want to do and what we will probably focus less on.
Thanks.
We're in the last 10 minutes of the webinar. So the one topic I want to talk about before we close the session is about a business's relationship with its employees. We've seen a lot of startups having to let go of employees through this period. And I was wondering if once the pandemic passes and once business, hopefully things get back to normal, do you believe that it will be harder to engage talent? Do you think there's some trust deficit that has been created? And Namit, if you can come in with this, what do you think during this time that that businesses need to do to keep communicating with employees and tell them what to expect when things are going to change, to calm the waters?
Sure, Tanya. I think it's an especially important time to be very, very connected and engaged with your employee base. I think, like you said, there are challenges at a structural level where obviously there are hard decisions being taken, and also the very dramatic shift in the way most companies now need to operate, which actually came with no notice. I think it compounds the necessity for, in some sense, there being a lot more engagement, though digitally. So both on the engagement front in terms of communication, just sharper articulation of priorities, just given the also the dramatic changes in the demand patterns for many businesses. I think just keeping a very sharp eye on how the employee base is feeling and what your high potential talent actually wants to solve for is very, very critical. So there's probably two parts to the story. One is obviously as leaders in the firm, the founders and the leadership team needs to make sure that everyone in the employee base is actually feeling heard, feeling connected, and that they're clear about what they need to work on, because productivity will be very, very critical even as companies try to trim the employee base that they have. And your second point around the longer term effects of trust deficit, I think the fact that this is a black swan event in many, many ways is very clear, not just to companies that are making these hard decisions, but also to the talent that's had to be at the receiving end of some hard decisions. So I do feel that with that perspective in mind, as things start to improve and as companies start to increase their employee base again in line with growth and demand, there should be not that much of a trust deficit. Hopefully things should start coming back.
Vivek, Upasna, one of you can come in with your views on how it's been in your sector. Either of you, who would like to take it?
Go ahead, Upasna.
Well, I think I might have a contrarian story to tell, so I'm not sure. I think that so we haven't had to ask any employees to leave or to take pay cuts. As I mentioned, we had already done all of that work in the previous 12 to 18 months. So the entire financial year last year, we had employees in the range of 320 to 350. And we had the same number pre-COVID, and we are at the same level right now. In fact, we've actually hired 30 people in this time because there's a lot of good talent available. And I think I do understand that, companies with very large operations, human operations may, have to take the right steps that are appropriate for them. I'm just saying from our point of view, from a digital payments and fintech platform, I think we've found a lot of good resources. And also, what we found in our last year's performance, that by maintaining a very stable set of employees and clear priorities, we were actually able to generate far more revenue per employee. So for example, in FY19, the same set of employees we had, our revenue per employee was 0.4 crores, and in the next financial year FY20 we were able to bring that to 1.3 crores. So I think from just a narrative point of view, I think we are going with a very steady ship kind of situation where we want to retain talent for long term and try to get the best out of them. And so we haven't had to do any cost optimization on the people front, although we have done cost optimization in all other areas.
Vivek, I think from you on the subject.
Yeah, so for us, it's very simple. We have consumers who used to love this convenience that we used to provide on food delivery, and we need to basically build the trust on the category and get them back. And we also have new businesses that have spawned in the middle of this COVID lockdown crisis that we need to think about how do we scale them in a way in a new world which is lot more sort of financially sedate and not blitz scaling world. How do we make sure that we scale those businesses that we see line of sight to profit for? So I think there is a duality in the company in terms of rebuilding the company that had gotten sort of almost decimated to a day, and at the same time trying to still have that animal spirits of growing small businesses and so on and so forth. So I think if we are able to maintain that duality, the future should be positive, and that's where we are spending a lot of our energy in terms of creating a plan for the future.
Okay, Mihir, any last questions for the panel?
Yeah, so I was just wondering if apart from the general push towards digitization that everyone has been talking about, that the pandemic has just triggered, what are some of the long-lasting changes that you think this will leave on businesses that will outlast the pandemic?
So I think
Maybe Yashish, you could talk about.
see, physical meetings. It's an obvious one, but that has been a problem. But I think just think about it. Many people have not shaken hands with a second human being or with a second outside of 3 months, 4 months, and I think that particular piece is going to stay. Just that. Like I'm in the UK right now, and in the UK, COVID is pretty much over. Practically, it's over. There's like almost no cases, almost nothing happening, right? But that physical distance is very much there, and that physical distance and the fear of what physical. I think this disease has brought it in much more. So I think the very obvious thing here is it is not just digital customer coming in, but all your processing is being digital and non-physical, which is going to be a major challenge. People will trust automation and non-people a little more than dealing with people. And whether it's billing, whether it's education, whether it's whichever area, you're going to see the physical distance. Whether it's medicals, in our industry we have to do physical medicals, so you will have some mechanism of medical kits going to customers and they kind of doing something themselves, or some telemedicine or some video based medicines happening. But physical is a big problem right now, and it's going to stay. I don't think physical contact piece is not going to disappear. I would say over the next 2 years also.
Right. GV, I thought.
I wanted
sure.
to add something which I thought might be interesting. So interestingly, both on payments and credit, we work with banks very closely. And interestingly enough, we all know how much investments banks in India have done in tech. So, on the aspect that Yashish just spoke about, all of a sudden, all the banks have risen to the fact that, humne to digital banaya nahi hai. We need to have, you will not believe, I will not name, but the top private banks in India for very simple loan products do not have 100% digital flow today. And they are struggling to build it right now.
Right.
And there's been a huge trust, I believe, at least in the financial service industry. Somehow there's been a huge trust in wet signatures and all these kind of funny things. I remember I wasn't a good student when I was about 8 years old, and the teacher used to give this report card to get signed by parents. I signed for my parents all the time.
Yeah.
So I don't know. Even today, and I shouldn't be saying this, but even today, sometimes my wife signs for me. I sign for my wife. My mother signs for me. I have a few people in my office who sign for me on personal checks. So I don't know what's so big about the signature piece, and this wet signature and physical meeting. I don't know what's big about it.
Yeah.
Digital is far more traceable, trackable, trustable. Yeah, that's
Sure.
it. So I think physical is not required, and I think that the world will just move to that.
Sure. So just to wind up, I thought maybe GB, you can just talk a bit about how capital itself could change with the course of the pandemic. Because again, just to go back, we've been talking about how generally valuation drops were expected. Public markets had really gone into a tailspin in March, but again, the recovery has just been so rapid and so sharp that it just makes you wonder if the whole like idea of capital. I mean, people are just willing to pay more for growth, like you said. So how could that larger piece on capital affect the venture space?
Yeah, so there are two scenarios, right? A scenario where a lot more capital becomes available in some time frame, in which case you will find much more innovation getting financed, and which is kind of mostly what we expect to see, because we do think there is plenty of capital available and good ideas, and particularly venture industry focuses on technology-driven innovative sectors. And given what we just spoke about, how much more digital and digitization is going to happen from adoption perspective, we do believe a lot more will come their way. I think that is certainly something that we expect to happen. There is an alternate scenario where there is some significant correction, because there is a view that some of these markets are propped up by the liquidity, because governments have put money in pockets of people, etc. And if that were not to continue, then you will see a correction. If that happens, I would say India is not going to be spared. Like we have, many times spoken about India being decoupled from global, etc. But in all honesty, we have consistently seen that if something happens in the US, it does have an impact in India, mostly from a sentiment perspective. And in which case, the good news is I think startups are well prepared in that people have tightened their belts, have thought about how to sustain themselves for a much longer period of time, and they'll have to kind of continue the discipline moving forward. But chances are that we are likely to see much more capital being available, especially if you're in a technology sector and you're in innovation sector. And the last thing I'd say is, even if you're not in technology, given what's happened with COVID and the level of trust that people need to place on brands, organized companies are likely to benefit from some of this, right? Because if you think about how we have behaved in the past, we were not thinking about the people who we are letting in, the kinds of products that are coming into our house. Now, some of that has changed. You're going to start thinking about, look, is this a product that I can trust? Is it coming from a brand or a company that I trust? So it will favor the more organized, sector, and they will be willing to and will make the right kind of investments to bring about that trust in a post-COVID world. So I would say overall that will benefit companies that are working on those kinds of the right issues.
Thank you so much, GB. And with that, we'll have to close this session. We've absolutely run out of time. Would we, all of you, thank you so much for being here. Thank you for your time.
Thank you.
It's clearly interesting to see when things are going to change in India, when things are going to get better. And at Mint, we'll be keeping close watch. Thank you and good evening.
Thank you.
Thank you.
Thank you. And great to be here with everyone.